So next up, we have a panel that follows the same theme on the future of digital assets. The topic is on the unstoppable rise of digital assets, compete, collaborate, or both. We have a great panel of speakers who are able to join us here today. Firstly, we have Rana Dasgupta, who's the MD and Head of Global Market Structuring for Asia, excluding Japan, from Nomura. Hi, Rana. Followed by Eric Neo Se-Wee, founder and chairman for Neo and Partners Global and president for HG Exchange. Hi, Eric. We also have Daria Sid, managing partner from QCP Capital. Hi, Darius. Hello. Followed by Sisi Lu, managing partner for Asia from Apollo Capital. And we also have Philip, who's the co-CEO for B2C2, who has managed to join us here virtually. Oh, hi, Philip. Hi.
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 Can you guys hear me?
Thanks for joining us, Philip, all the way from Japan.
Great.
And of course, we have Kevin Ginn, the MD for Alpha Capital, who will be moderating this panel. So let's welcome our panelists, and over to you, Kevin. Thank you.
Thank you very much. Thank you very much, ladies and gentlemen, and for the audience also for participating in this session, this afternoon session. We're the second last session, but hopefully everybody is still energetic enough to ask questions thereafter and alleviate me of some of the honor. But let's start. Obviously, this topic is about digital assets, and what has obviously been at paramount on everybody's mind is the latest announcement by the Chinese government with regards to crypto and the specific industry. And perhaps we can get the feedback from the panelists other than what we read in the press. Ladies first, Cece.
Hi. Yeah, sure. Thank you. So I think, first of all, crypto market is facing, regulatory uncertainty risk. So countries like, China or some part, like, US can, or the big countries can ban Bitcoin, but the nature of crypto market is decentralized. So because of that nature, just because one country is banning it, it does not mean, the industry going to disappear. It's just going to be adoption of the technology, blockchain and crypto going to be slightly different. So that's my view.
Hi, I'm Darius from QCP Capital. We are a trading shop based in Singapore. I want to say hi to Phil as well. I haven't seen Phil in years.
Hey.
Yeah, I mean, I don't think it was any surprise to anybody that China has a hostile stance on crypto, especially with the launch of their own digital renminbi. I think the view is that crypto is, or specifically stable coins, are a competition to the implementation of what they're trying to do. And if you look at it from a more philosophical perspective, you have uber centralized currency in the form of the digital renminbi versus something that's completely decentralized, or rather not completely, so largely decentralized. To add to that, there's also capital flight. To add to that, there's AML. And I think China has, over the years, we have tried to participate in the onshore OTC market as well. That's always been very difficult. They pay a lot of attention to some of these, fiat peer-to-peer transactions. So even before the regulations that was announced last week, we had already heard about detentions of exchange employees. So the joke was going around that if you are messaging somebody from Binance or Huobi and they stop messaging you after a while, you better stop messaging them because the government will be reading your messages. So I think no surprise, but at the same time, our view is that, sure, China has over the years tried to clamp down on this, but every time they clamp down, the market bounces back because that's the nature of the asset class, right? It is meant to sort of circumvent heavy-handed regulation. So in this case, because they are enforcing it quite truly in both the mining, the OTC, and at large, this is the biggest enforcement we've ever seen. I think they will be able to block some gateways, and there's some block some of the entry of new money coming in. But a lot of the money is already in, so I don't see a huge impact per se. So I would say maybe the future inflows might be blocked a little bit, but we don't see much stopping. So I think the biggest impact was of course on all the Chinese exchanges. Huobi token, OKX token, took a big hit. But at the same time, you saw the flood coming into decentralized exchanges like DYDX. So, I mean, I will caveat that I'm a shareholder of DYDX. But you have for once you see a decentralized exchange having higher volume than Coinbase, right? That has never been seen before. So you see that there is a direction of flow away from centralized exchanges to decentralized exchanges. So I think there is impact, of course, on the fiat gateways, but we see the market working around it, and we see things respond and react to this. So yeah, that's my view.
If I may add to Jerry's comments, if you look at from the exchange perspective and the regulation, Singapore MES is very forward-looking, facilitating certain new entrants with a framework for them to establish here. Then you saw recently in the news, Channel News Asia, if you read, a real estate firm is now pivoting their real estate in Malaysia to convert it into a mining facility, right? A joint venture with another party. And as such, on the consumption of electricity, what's even more interesting is they decided to then install solar panels on the building to basically save on electricity. So the market is moving, like you said, circumventing, and the real estate firm one is the ones that's really intrigued me, that they are pivoting into the area of mining rigs, right? So, yeah.
I just want to add one more thing. And I think this is really important because there's obviously a lot of focus on China, but it's really interesting because when you think about crypto, perhaps there's some macro theme that's finally kind of driving crypto as well. And I think it's important to look at developed markets and emerging markets. And what I notice is that a lot of countries, especially that enforces capital controls, this happens quite a bit, right? When Erdogan did capital controls because Turkish lira was collapsing, what we notice is that there's a pickup in crypto interest. So I don't think that it's a coincidence that when you see Evergrande and the kind of the property bubble potentially taking a risk, China immediately followed up with banning of crypto. So for the audience, I think that there's a lot of crypto skeptics as well. I mean, if it's not a real asset class or something that doesn't have much utility, a lot of these governments wouldn't be enforcing these kind of rules. And it's really important to start thinking about the supply, demand, and the overall kind of market kind of intertwining of these things that's happening, right? I think geopolitics, especially in EM, and crypto price kind of appreciation and banning is going to go hand in hand, for the foreseeable future.
Yeah, thank you. Well, first, just a sign of times, all views are my own personal and don't represent the firm. I had to say that. So with that out of the way, look, I think actually maybe slightly divergent. I think regulation here is actually a good thing. And the fact that regulators world over, not just China, are actually being active, whether it's to say yes or no. Singapore is, perhaps more proactive. So is Japan. So are parts of the European Union. The US is on the fence. Actually, if they all cross over to the fact that it's a regulated asset, that to me, sitting in a bank, actually perhaps legitimizes the whole space. And that's actually when it gets big. So yeah, I think, part of the panel's discussion today, I'd be very interested to hear, Kevin, what the other panelists say. I've already kind of stated my point and would like to see if it's challenged.
I mean, the concern about regulatory, it's quite well publicized within the media and also the various regulators. I think I saw Binance hired Richard Tang, and Richard Tang is an old friend of mine, and I picked up the phone and gave him a call. Oh, what are you doing? Let's catch up for lunch. So obviously the crypto exchanges are taking a lot of interest in this space. But moving on beyond the regulatory aspects, the other considerations that seem to crop up is fungibility and conversion to something which you can actually use in the world of ours today and to buy something. So that's one question. And then the second part is, the other question is, what are the top 2 concerns or you have as individuals within your firm that impedes your business that you think should be dealt with? I might skip CC first and let you think, and then give it to Darius, move down the line.
What was the first question again?
Apart from regulatory, you've got the fungibility
Right.
of
Right.
crypto assets, digital assets.
Well, I mean, our firm, part of our business is the fungibility of digital assets. So, ironically, the less fungible it is, the better for us. So, you get wider spreads and all. But I think it's becoming more and more fungible, mainly because more assets are in the digital space. I mean, the people nowadays are very used to money being digital, right? E-money. So it is quite a nice transition where, people are used to this. So they don't need to hold cash to feel that they have cash, right? And actually Asia is really advanced in this, right? And probably China more so than Singapore. I mean, the story I used to tell was in 2019, I was with my wife in Shanghai. She took out cash to pay for coffee at Starbucks. Everyone looked at her like, well, which village did this girl come from, man? Because nobody pays with cash. They all pay with they all pay with E, right? So I think it becomes very natural for us to be using digital money. The next step then, is you have digital fiat, stable coins, and then to have speculative assets then priced in this and people to hold it in their wallets, ledgers, it's very natural. So fungibility becomes less of a problem because the assets, the ecosystem is all digital now, right? Less so a need for physical assets. I mean, increasingly we've seen a lot of demand for guys who want to buy cars or houses with digital assets, right? And then the broker comes to us and we work on the fungibility. And then you also have loan facilities, financing, trade finance, that's all digital. So I think fungibility is becoming less of an issue because more assets are digital and therefore it all stays in the ecosystem. Again, which is why I said, in China it's not that much of an issue because a lot of them have already transferred physical assets into digital and then it all stays there. I think if you ask most crypto natives how much they have in their bank, I mean, we won't even qualify for DBS treasures because our cash it's all in our wallets, and our risk-free rate there is like 10%, right? So, and as to your second question, what's the risk? The biggest risk I see, I think some people might expect it to be infrastructure risk, but I think that has developed quite well in terms of the solutions for that, and we can discuss that later as well. But I guess risk for us, I think one risk that we see is the crypto space is a highly leveraged space. As much as some guys like to deny it, but it is a highly leveraged space. So I think that is a big risk in terms of how much leverage there really is in the space is hard to tell. And the whole DeFi space is as much as it's transparent in the chain, the amount of leverage is not, right? The amount of what do you call it? Hybrid hypothecating, and this is not regulated as well. So leverage is a concern. The exchanges recently dropped from 100x leverage to 20x leverage. But if you tell somebody in traditional finance 20x leverage, you think you're mad, right? So leverage is a concern. I think that would probably be our primary concern. But at the same time, that's also the reason why the space has a lot of volatility, and we trade a lot of options, so that works for us. But I think the black swan events, right? In the last 4 years in crypto, we probably have three standard deviation event per year, which is unnatural, right? So something to think about.
So I do have something to add. Like one of the things developing is a central bank digital currency, right? So the idea of the fungibility is from crypto asset become fiat, right? And then how is transfer back to real cash that we feel comfortable with? One thing is, I think a central bank digital currency can provide this off-ramp service that become more broader adopted in the world. And number two is, I think converting crypto back to fiat, there's a conversion risk, which is kind of like investing in the EM market, right? You can buy Korean bonds, you can buy Indonesian currency bonds, you can enjoy the high return. There's always a risk of the currency when you convert back to US dollars. I think that risk is not just the fungibility risk for crypto. It's quite similar to the traditional finance that converting back the currency risk.
If I may bring two analogies in terms of, okay, so the first thing is, I'd like to talk about bringing a comparable product. For example, CFDs, contracts for differences, right? It's a synthetic product. Yes, it mimics the shares of the underlying, but at the end of the day, the contract has no asset below it, right? But it's regulated by central banks or licenses brokerage, right? So could it evolve, taking that as a concept, could the cryptocurrency market evolve into that, being like a CFD, right? Now, the second thing about impediment to the business is, as I'm involved in HG Exchange, we do securitization of tokens, of assets, right? And it's basically according to the MAS approved products. The question is, when can it be bankable? When can I take that token that is securitized, recognized by MAS, and go to the bank and say, hey, I own 5 million of this company tokens. Can I get an LTV on it? That's the one that actually I'm waiting if ever it will become bankable. Yeah.
So to me, I think
to the Nomura.
Yeah, no. So Nomura's out of it. But you can talk to me. You can't actually really fund assets. So, I mean, I'm taking an opposite view here. I think actually it's less fungible as it stands, right? You can't actually go to a bank and exchange it quite easily. I think the fundamental issue here is that, at least with the coin, the physical coin, which is obviously not physical, but the coin itself, the whole USP of blockchain is that it's anonymous. It's not anonymized, it's anonymous. I think what you're talking about is a token which is anonymized, but it can be traced back to its owner. But a Bitcoin or Ethereum cannot be by design, and that's the intent, right? So actually, it's not fungible. And actually, what is a lot more fungible is the derivative on the underlying. So whether it's a CFD or, frankly speaking, you just have to look at the currency markets, and the whole market is NDFs, right? To what CC said, how do you hedge Korean won or rupee or rupiah? You hedge it offshore in Singapore with an NDF, which is actually perhaps a lot more easier than actually going onshore and hedging it. So to some extent, actually fungibility is not easy. The derivative is a lot more fungible. The risk to this product obviously is the same reason why fungibility is not easy, is that it's anonymous and you cannot KYC it. You cannot identify the actual owner of the asset. And if you can't identify the owner of the asset, you cannot take it to a bank. And you cannot actually convert it because the whole intent is potentially the best use case for crypto or Bitcoin or any of these assets is that you can transfer money anonymously. So who sent it and who received it, you don't know. If you have the private key, it's yours. And that's a big risk. Nobody likes that, right? If you're in a bank, nobody likes that. If you're a regulator, nobody likes that. If you're a government, you definitely don't like that. You cannot tax it, you cannot identify it, and you definitely cannot control the flow. You can only ban it, but even that doesn't work, right, as we just discussed. So I think that's a big risk. But once you can,
maybe I can.
it works out.
Oh, go ahead.
I'm sure. Yeah.
Okay, to address your
Sorry.
first question about CFDs, most of the leverage in the space exists as a CFD type product, perpetual swaps, right? And actually, you should ask Phil about it. V2C2 has a CFD product as well. You can ask Phil.
We'll talk offline.
Phil, maybe you'd like to share your thoughts.
Yeah, sure. I guess I don't want to maybe exhaust the conversation on fungibility, but to me, the first question you asked, and I'm sure the question that the audience might have is, what's the fundamental value of cryptocurrency to begin with, right? And I just want to quickly go over that because fungibility perhaps is one of the values and exchangeability as well. But for me, there's around 4 fundamental values that gives any crypto, a value as an asset. The first one is the fact that I think everybody knows right now, in this kind of a very inflationary environment where there's so much printing going on globally, having this kind of limited supply gap or having a proof of stake system is quite interesting. And I think when you compare gold, which has been traditionally a hedge against kind of fiscal irresponsibility by the governments, gold has underperformed significantly to crypto. And I think that's a very important point, right? And that's one value that it definitely has. Whether it's Bitcoin or another coin is a different debate, but crypto represents one value there. Another one is what we keep talking about, which is the exchangeability, the fungibility, and so on. And this kind of goes back to the point that I mentioned earlier on, EM, DM, different kinds of demand. From an EM perspective, if there are capital controls or if there are crashing currencies, it's, crypto represents an excellent way of kind of moving your cash from one location to another, much more than golden bars or, other kind of fiat, which, let's be honest, I mean, the SWIFT network, overseas transfers, I mean, these are very inefficient mechanisms. And I think it represents a revolutionary way of kind of transferring your cash and your assets, right? I personally think that it's very easy to transfer from Bitcoin to fiat, but we'll see if that continues. Third thing, ownership. The fact that you have self-custody. A lot of assets that we own, do we truly own it? Hard to say. But with cryptocurrency, you're able to have that ownership. And add to that the smart contract nature and the ability that all of this is programmable. I mean, the truth be told, I don't think a lot of people understand, how much crypto could potentially, shake up the existing financial system. And I mean, definitely keep an eye on something like gold, which is not trading too well since the COVID crash last year, right? So you are seeing this natural shift to crypto because it represents these 4 values. In terms of risk, there is one risk that I think is that we take it very seriously here at BTC2. As governments move towards CBDCs, and again, the reason is very different for each country. There is a DM, EM, very different kind of an angle to move towards CBDCs. But we feel extremely worried about stable coins that already exist in the ecosystem, such as Tether. So, I think, for us, that's probably the biggest risk. And for us, we've thought of many contingency plans because naturally, I think CBDCs are coming. And when it comes, I think that it's going to create a bit of a shock to the system, at least a one-off shock and a liquidity shock to the system.
And if may to add, so I think right now the crypto is a very new industry, and then people tend to think investing in crypto is just Bitcoin or buying some NFTs. But like Apollo Capital, which the firm I'm representing, so we manage crypto assets as like a hedge fund structure, right? We provide our redemptions monthly. Right? You don't have to lock your money in for a period of 1 or 2 years. So you can withdraw anytime you want and transfer back to your bank account. So they provide almost like an assets layer for investors to have exposure to crypto assets and still feel comfortable that if you redeem your fund, your money will back to your bank account. And also another thing is people don't really, I think the education in this space is very important to understanding what it means by like decentralized finance, right? Why there's so much capital going into this space, why everyone wants to have exposure to it. It's not a casino to get rich quick scheme, right? So the idea is this technology, blockchain technology, is like a history-altering technology. It solves problems that our current system, financial system, cannot solve. Number one is improve financial inclusive. We take credit cards, Apple Pay for granted, but the whole world, we have 2 billion people, according to World Bank, who are unbanked. It's not because they're far away from bank machine. It's actually their lack of their identity proof, so they're excluded from current financial system. Decentralized finance is also called DeFi, providing like financial service, a banking service that traditional banks cannot provide. And they reduce inequality, they improve empowering women, because large portion of unbanked population are actually women, right? And then also another thing the previous speaker touched on is a smart contract. That's a kind of digital agreement that's black and white. If A and B occurs, therefore C. There's no human interpretation of a contract, of a law. So therefore, on this decentralized finance world, it doesn't matter if you're Elon Musk or you're Afghanistan refugee, you're equal, right? So that's to my point that what I believe is like crypto assets is actually very ESG, right? They including the population that current financial system not even considering.
Okay, sorry. Obviously, the digital space has been around for a fair while, but in terms of the hockey stick, in terms of interest, has been in the last 3 to 4 years. And the question now arises, we are where we are now. If you were to come into the industry now as a new entrant, whether as a young graduate or a businessman, where would you position yourself to be on the uptake for the next 3 to 5 years?
Maybe I can start. So I guess it's important to know the history of cryptocurrency. I'm sure everybody knows that crypto was created in the midst of the financial crisis. First Bitcoin launched back in 2009. This is my personal opinion, but for the last 11 years, crypto has been a retail-dominated and retail-oriented asset class. And as like we just mentioned, things have changed in the last 2-3 years. Well, what's happened is that for the first 5 or 6 years of crypto, it is true, and as part of the history was that there was Silk Road, and part of the history was that there was Mt. Gox. Part of the history was that there were a lot of hacking. But regulation really started to come into play from 2015 onwards, and you started having serious players coming to this field. I mean, if you look at myself, and Darius and others who are on the stage, a lot of us come from traditional finance, and we've transitioned, I think, all around the same time, 2017, 18. And when you had this huge migration from both sell and buy side firms coming into crypto, you started having the ecosystem develop, the infrastructure and everything else. So where we are right now is this kind of inflection point where we're moving completely away from this retail/crypto exchange dominated market to something else. And what do I think that something else is? Well, I think that it's going to start looking more and more similar to how, say, the FX market works. I mean, if you look at right now, there are over 450 crypto exchanges in the world. This is quite a bit. So if there's a new grad who wants to come into crypto and they're really excited about crypto exchanges and so on, I think that's the wrong kind of area to focus on. Where you want to focus on in terms of the microstructure side is the business is going to move more OTC. There's going to be more products. There's going to be more products and services that traditional investment banks have been used to offering, right? It's not just about spots and CFDs. As Darius can probably talk about, there's a lot of options product, DCDs, and so on. The need and the interest are picking up. simultaneously NDFs and so on and so on. So creating these kind of sell-side products and services is a huge thing. And we're going to move from retail to more OTC and institutional. And that's going to be the main thing in the next 10 years. But that's just the microstructure. There's also a lot of interest usage coming from smart contracts and other components of, other characteristics of cryptocurrency. So really, I think what's important for the audience, and especially people who are coming into crypto, is to understand the history and understand where we are relative to, this kind of relatively young asset class, and realize that in the next 10 years, things are going to look very differently. And I think it's going to be much less retail oriented, way more institutionally oriented. And what does that mean in terms of the product service that's going to exist in the ecosystem?
So, I'll second a lot of what was mentioned by Philippe, right? So I think there's two elements here, and I think I'm not an expert in this field at all, but there's one is the asset and one is the technology, which is blockchain, right? So I think let's leave the blockchain part of it aside. That there's a lot of good in that. Let's just talk about the assets, the coins that are trading right now, and I think that's the hockey stick question. So the hockey stick question is definitely, it happens when institutional money gets in, right? And OTC is going to be the name of the game, and that kind of represents my interest in it, because what happens here is, we structure derivatives on equities, CFDs, FX, commodities, fixed income. This is going to become just another asset, probably a small asset within the FX space, a commodity space, depending on what the regulators choose to classify it as, but one of the two. Singapore has already come out with a Payment Services Act, which squarely covers the product. So it's a regulated product for the large part. Banks can offer it without actually getting additional licenses. You can do it right now. Most banks have announced some initiative or the other around it. A lot of surveys have gone out and they've become public now. Obviously, large institutions, asset managers have publicized them. So a large American bank went out and said that 10% of their clients are already trading crypto. This was last year. One of the large accounting firms went out and said 20% of the hedge funds are trading crypto, and crypto means Bitcoin, Ether right now. There was a perhaps bias survey, I would say, where one of the large asset managers surveyed 1,100 of their clients, and 52% of them were already trading crypto, with a lot of the interest actually in Asia, slightly less in Europe, and even perhaps lesser in the US, but definitely the trend is already there, right? So as a sell side, we're going to join this, if nothing else, from a FOMO, right? We don't want to miss out if the buy side is actually trading the asset. We're here to make markets. In the end, we're going to make regulated markets. Hopefully, we don't actually touch the underlying coin, which is anonymous. You just touch the stuff which is actually provable, right? So that is going to really take the volumes off. I think if everybody talks about crypto as having exploded a lot, actually what is exploded is exactly what is mentioned. It's the CFDs. It's the perpetual swaps that have actually exploded, because they're far faster to settle. They're cleaner. You can get in and out quickly, but that's effectively exactly like a derivative, right? It's defined as a derivative. It never actually took off when it was defined for other asset classes as a future which actually expires on a given day. This just rolls every day, and you have a liquidation mechanism, and especially because leverage is so damn high, you actually have to self-liquidate very quickly. And it cannot actually trigger a failure of the exchange, right? So again, talking in terms which a banker realizes. You understand what exchange failure means, you understand what OTC counterparties mean, you understand what settlement risks and counterparty issues are, KYC. So all that sorts out should actually probably happen in less than 3 to 5 years. You need 3 banks to get in, and then 30 will be in 6 months, and then everybody will be in 2 years.
Yeah, like for example, I think institutional involvement in the crypto, in digital asset space is because, for example, like on Australian Morningstar, right? Our fund, Apollo Capital Fund, is ranked #1 on the performance table for 1 year and 3 years performance, compared to 9,000 other funds. So clearly, Morningstar were some the more of avant-garde asset managers are really get involved in crypto. Well, it's in the sense of a case of FOMO, but then also I think, for example, our target in Asia is private wealth and family offices, right? I think large demand is actually driven from asset owners, right? Like for example, the large investment banks, you will have like a wealth management sector. You know, you're gonna have more and more next generation investors saying, well, we would like to have exposure to this technology, to this crypto asset class. You know, we demand such service. If you don't provide that, someone else is gonna provide that. Right, or they can directly come to a hedge fund like ourselves. So I think that's yeah. So I think it's institutional. Oh, another point I wanted to say is that what banks can get involved is custodian services, perhaps, because banks have the reputation, have the trust from general public, and also all the banks spend billions of dollars or millions of dollars on cybersecurity, right? So you already have the infrastructure to provide digital asset custodian services. And I think that's really what right now for digital assets really need is a third-party custodian service.
So I actually get this question a lot, right? Like whether it's for a new person coming in, whether it's too late, have I missed the boat? You know, I think the answer is no. I think we're just getting started. I mean, when I visited Phil's office in 2018, 2019, you know, we were talking about new projects, new things coming up, market growing. You know, and we came from, like Phil said, we came from traditional finance background, so we see the potential. And I think if I met him now, the only difference would be his office is bigger with a lot more people. But we will still be talking about the same things, right? We will still be talking about new projects and new products that are coming out. I mean, just a few examples. Options in crypto, which we focus on, is still a very small market. You know, it's grown in multiples, but if you look at the overall size of the market, it's about 2% of the market. If you compare that to traditional finance, option notionals are in multiples of the spot market. And it's developing very quickly. There's a lot of potential there. You look at stuff like in DeFi. I mean, there's a lot of funky stuff that's gone on, and you know, it's been gone through a boom cycle, and then now, you know, every project looks about the same. You know, over collateralized loans kind of thing. So I mean, but at the same time, there are new innovations that are happening, right? And talking to new projects, you find more of these asset management on chain. You know, and then and it's quite scalable. I mean, there's some projects that have raised, you know, hundreds of millions of dollars, where hedge funds struggle to do that in years, right? So, and you know, there are scalable ways to do things. You know, play to earn has been a phenomenon this year, right? And it's just getting started. You know, I mean, the biggest game was AXS, Axie Infinity. You know, everyone thought it's like some Pokemon game kind of thing, but then it's making a difference in people's lives in emerging markets. You know, like Phil said, there's this emerging, you know, developed market thing. In emerging markets, suddenly these people, you know, people who are, I mean, cab drivers or normal workers, are able to play a game, earn 4 times their salary, and make a new living, right? And that's just the first game. You know, there are new games coming up, new kinds of economics. So there are a lot more exciting things that are coming up. So there are a lot of parts that are scalable that in traditional finance terms. There are also a lot of parts that are going to be more scalable. You know, that are more on the sideline, but you know, this new ways of doing things. And I think this year has been, this 1.5 years, I think, has been, you know, like you guys mentioned, the incoming of institutionals. But they only see one part of the market. There's a lot of development going on. There's a lot of adoption in parts of the market that are quite disruptive. So for someone coming in as a new entrant, you know, there are a ton of things to look at, a ton of things to make money on. I think crypto is one space. I just had a meeting with one of the high-frequency crypto guys. He's like, I come into the office every day and there are 100 things that I can make money on, and they all make money, and I don't know which one to do, right? So I think that's the kind of space we are still in. The markets are still inefficient. The markets are still at infancy. Some parts of it, of course, are getting more and more efficient, but you know, there's still a lot of opportunities.
I think my opinion would be if you split the segment into trading, right, and then the other side, which is more the wealth side of investments. So I think what Philip mentioned about market structure or market infrastructure is getting better, so that then you can see, you know, even for myself, I'm keen to look at like CC's company where there's a structure of an investment product underlying in the crypto side, so it attracts me. But on the flip side, on the trading, then yeah, maybe for my own personality, I'm not the risk taker type, so not too much. But you're right, there's many things happening. Case in point, in 2009, That was the tip of the CFD market in Singapore coming into play. You have your CMC markets, IG, Saxo coming in. Fast forward, how many years has it been now? It's now has flourished. Ahead of before 2009, Australia listed ASX CFDs, an exchange listed derivatives, right? So could it be the next evolution into that space of CFD, but in the context of crypto, right? But so it's about market structure. Yeah.
I mean, there's thank you, lady and gentlemen, for the feedback. I think I have two questions to ask. One is with regards to CFD. The underlying is an asset class which people are familiar with, and you can actually value. Then there comes the question, if you're actually investing, if it's trading, you can be a momentum trader, or you can be a value trader. If you're a value trader, obviously, I spoke about DCF, discounted cash flows, earlier on. How do you value a digital asset? A Bitcoin or whatever it is, right? That's the first question. And then the second question, it comes back to, or follow on with what Philip had said earlier on, the institutional money coming back in. So here I'm at a quandary. Right? You have institutional money that's coming in or potentially coming in, but the biggest issue, if it's institutional money, you have fiduciary responsibility. If it's fiduciary responsibility, how can you buy something that is not regulated? Right? So how do we cross that bridge? Those two questions.
Maybe I can give it a stab. So we introduced CFDs to institutional clients at the beginning of 2018. I think we're one of the first companies to start trading CFDs. The reason was when I opened B2C2 in Japan, our headquarters in London, but when I opened in Japan, our clients were very large. It's the likes of, I don't know if you guys are familiar, like Rakuten, Line, GMO, SBI, DMM. These are all very large companies, most of them with listed parent companies. So this addresses both of your question, actually, because one of the reasons we have to go into CFDs, and one of the reasons we chose to, was that from a regulatory standpoint, it was clear. I think the regulation is moving east to west. Japan was one of the first countries to kind of have these kind of virtual asset, service provider licensing established back in 2018. But physical trading was extremely unclear. Even the banks didn't really want to touch it because they're just saying there's AML concerns and so on. But derivatives were okay to trade. So what we did was we created the CFD market. Now, the CFD isn't that difficult in the sense that pricing-wise, we price the same as spot. There's no difference in pricing. There's a difference in the overnight funding rate, which is derived from the basis difference in the futures. So truth be told, although, right now, I think we're we must be one of the largest CFD liquidity provider globally from the institutional side. The clients who are looking to trade CFDs are usually guys who are either interested in cash and carry or some kind of hedge from a hedge perspective, or retail brokers who are offering the CFD products down to their retail clients. There's a few very interesting things here. For one, I'm going to kind of jump subject, but this is a very important point. Have you noticed that the volatility of crypto might be kind of getting reduced, especially for the larger market cap ones? I think that one of the reasons for that is, regulation around the world are now capping the leverage. So there's been a lot of talk about leverage in the system, and there's definitely a lot of leverage in the system compared to other asset classes. But I would argue that as regulation starts to be more established, you actually see one of the first places where you see the impact is that there's leverage cap. The days of trading at 100 times leverage is coming to an end. The same thing happened with spot FX and margin FX as well, right? And we're seeing the same thing happen in crypto, which kind of stops these massive liquidation and huge kind of moves where sometimes people think that, is there, kind of manipulation or stuff. We think that it's just basically over leveraged positions getting wiped out. And I think that's kind of coming to an end. And this all kind of comes together because, as an institutional player, when I look at space, if I wanted to go into crypto in 2017, 18, it's unclear what the regulatory rules and kind of tax consequence and everything else are in order to do business. But those rules are quickly coming into place. We have offices around the world, and each country is kind of, at a different stage in this kind of regulatory cycle. But as it gets established, institution and others can come in. And when they come in, a lot of these products are now being built out. Brings to my earlier point about now clients are interested in trading NDFs, CFDs, options, spot, and so on. So I think it's very important to understand, and putting kind of everything together from a holistic point of view. We started with CFDs because that's where the regulation was. But really, once the rules are set, I don't necessarily think that crypto is going to be a CFD kind of or derivative oriented market. The spot market is also very large. Custody and other issues are things that need to be sorted, but in general, I think the whole entire market is becoming more and more institutionalized because the regulation and the rules are clearer now. And this is a very important point, I think.
So the valuation question, honestly, actually, I don't think there's any model, right? But to be honest, there's actually no really good model for gold either. 15 years, no one's actually been able to show me why gold trades at the price it trades at. I mean, it trades at that level. Yes, you can buy and sell jewelry, and certainly in India, a lot of people do, but beyond that, it's a store of value. It has been for a long time, and crypto's become a store of value, and maybe it will be for a long time. The other question actually is the more interesting one: is can you actually invest in it, even though you don't actually know what the fundamental value is as a diversifying asset class like music. You can, right? Because again, the same thing, if you actually have a custodian who's a regulated entity, or at least is under some form of regulation, it takes away a lot of risk. So you can actually store your asset without being worried if your PM actually loses his private key that the asset is gone. So that helps, right? It's no different from your password on your DBS Treasures account, right? You can lose it, but you can get it back. The second is, you actually trade. It's easier to trade the CFD because just like any other asset, you're just trading a KYC'd customer against a regulated entity. That's all it is. So you can actually trade anything because you're actually trading it in regulated venues. Or even if it's not regulated, OTC markets, they're at least being traded between two regulated entities. So it actually works just fine, which is why futures are so popular for crypto. And all firms, including mine, actually look at trading the derivative before they actually trade the underlying coin. Right? It's much easier.
Let's just move on beyond financial or digital financial assets. Let's talk about something like tokens, for example, tokenization, whether it's for real estate or NFTs. We know what it's like for the primary market, right? What's it like in the secondary market? I mean, OpenSea, for example, sells a lot of stuff. We always hear about the primary market, but what about the secondary market? Granted, for the existing crypto space, right, there's a good secondary market. ICOs are dead, so there's no more primary market, so to speak, right? So what's it like for secondary market in the token space?
Sorry, maybe let me start. The ICOs are dead.
For the moment.
Yeah, no, not accurate because they just called something else. There's a lot of deals going on. So I think the ICO, there's definitely a very, very healthy primary market.
No, what I meant was ICOs are dead because I don't get those invitations every other day now.
Good for you.
It's a good thing.
No, but the primary fundraising market is still extremely hot. I mean, I wanted to bring up this point on valuations, right? Because the recent projects in the last 1 year, everything has gone is like a minimum 10x. Yep. At some point for our VC side, it came to a point where when a deal is brought to the committee, we look at each other and we're like, do we really need to discuss what this project is about? Just put money lah. Should make 10x at least, right? I mean, it's gone nuts, right? So I mean, there is. I agree with you that there's no real valuation method here. It's just. I think in general the space is a bit under-owned. So that's the reason why you have these kind of valuations going nuts. But in terms of pricing and stuff, I think the secondary market is healthy. Of course, the bid offer usually reflects the liquidity. So and you have like Phil said, a lot of things go on at OTC as well. So for example, for options, the listed market is probably 25% of the volume, and 75% is still OTC, very much like FX. So it's a bit like a hybrid model, right? So you have some listed parts that function like FX, like equity options, and then you have an OTC that functions more like FX options. I think it's very similar across whether it be tokens, NFTs, or other coins, right? So the market structure is very similar, I would say. A healthy OTC market, some price discovery on listed markets, but if the less liquid ones are wider.
But like Kevin, I'm actually very curious to know where can you go and trade these NFTs on secondary, and how liquid are they?
Tokenization.
Okay, so being part of HG Exchange, so we are I would say Southeast Asia's first member-driven private digital securities markets exchange, and literally we can tokenize any asset class, right? And how do we do that? We actually work through our member firms who are literally broker dealers, corporate finance firms, custodians, right? Such as if Nomura wants to come in. So they would basically do the issuance, right? Do a valuation, everything. And then from there, we tokenize them and then place it on secondary market. Now, so what drives the secondary market? For an exchange like us, we look at substance. So say, for example, if there is a proprietary firm in Singapore that wants to do fundraising. So it's a company, right? So I spoke to the owner. I said, okay, it's a 3-year-old firm, good performance. The likes of your former flow traders, IMC guys, jump trading, they're all part of it. So I said, you want to raise 20 million. Okay, very good. So introduce it to our members and see who wants to do it as a lead manager. So that's sorted out. Once it gets tokenized or fundraised and tokenized and we bring it on listing, because of the nature of the firm, because it can do corporate actions, news announcements, it acts as a speculation, right? Like any single market. And in the case of Darius' firm, right? So if you do intraday profits, get announced and everything, it spurs people because there's substance below it. However said, the secondary market, in terms of product, it has to have size. So for example, if you only have 1,000 tokens, how are you going to generate secondary trading? It's limited. But if you have 1 million tokens, based on your company valuation, 20% equity goes in, then you have that community of people owning the tokens to trade. At the same time, we, as an exchange, we also have a program where we where we appoint designated market makers. So for us, one of the designated market makers that we announced in the press was Philips Securities, part of the market making unit. So we appointed them to be the market maker on our exchange, not on all products, but products that they are familiar with, like equities, like tokenized equity products, yeah. And then talking about NFTs, so we are looking at NFTs, but in consultation with MAS. However said, just recently, I was sharing with CC, I spoke to a potential issuer that wants to do NFTs, but I said, do it with asset-backed. Does your change the concept of an NFT that's virtual to an NFT that's asset-backed? And it's possible. I've seen a particular firm in the US that has done it for what they call exotic cars, vintage Mercedes. He digitized the image, but the asset still stays there. So it's quite an interesting concept. So it's evolving. Yeah.
I still think, like, for the crypto market, the learning curve is the biggest barrier for this market to grow. So, like, often people still thinking, oh, it's an ICO, it's Bitcoin, because that's just in the last 2 years, it's constantly in the news. But what is really the decentralized finance is about, and it is a very market-driven ecosystem. That, for example, like we heard of Ethereum, but that's only one of the blockchains that's pumping right now. There are many different blockchain systems that are providing a fast payment speed. They provide second and third layer to reduce the energy consumption. And for example, there's a new protocols are allowing us to trade carbon credits, right? And then there's protocols can convert this yield farming strategy, which is a variable yield, how that can convert to fixed yield. So they become more and more mainstream, just like a traditional finance. So to be able to participating in these kind of infrastructure or technology, it really require like professional knowledge in the space, rather than just hear some topic here and there. And therefore, I think, professional managed crypto asset service is quite important for, accredited investors or institutional investors or private wealth to get into this space, because it is a very time-consuming task.
Darius, any thoughts on your side?
What's the question for this? Oh, I'm good for this.
Okay, no worries. Okay, I think in the interest of time, because we have another panelist after this, I'd just like to extend our thank you to our panelists. Eric had to leave a bit early. Rana, Darius, Philip, and also CC. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank
We
you, guys.
actually have a couple of questions from our
sorry.
audience.
Oh.
So perhaps we can take one of them. The first one is digital asset custodians grew up serving retail clients. How do you think these firms are positioned to scale from retail into institutional grade offerings?
Maybe I can take this one. Well, we've seen the evolution of custodians over time. They start off as very, very simple technology, but now you have guys like Fireblocks, Anchorage, that have very specific institutional type technology in terms of KYC, facial recognition, multi-sig wallets, various platforms. Singapore has a few as well, on-chain custodians. So I think, actually these custodians are actually more focused on institutional capabilities rather than retail, because that's where the size is.
Great, thanks, Darius. Maybe we can take the second question as well. In the future, do we see a split market as retail crypto and institutional crypto?
No,
Yeah, maybe I can answer this real quick. I mean, there's not going to be a split market. It will be the whole market. It's going to be the total. But just like Darius just mentioned with custody, I think the first question was interesting to me, because I don't think that, custody providers and retail service is a very different market than custody provider for institutional. And the development and evolution is happening separately, right? One of the things that we're looking out for, and I'm sure a lot of the sell side firms are also looking at, is institutional only exchanges. It makes a difference, right? If you look at the FX market, there are many, primary and secondary markets where investment bank, make markets in FX, but the participation is very limited, and I think something similar is going to happen. So there's going to be a split in terms of evolution and then the product and services, but the market itself is a whole market, right? What's going to be impacted is liquidity, volatility, spreads. Everything else is going to become kind of similar to how I think EM markets evolved, in the last 20, 30 years. EMFX, yeah.
Great, thanks, Philip. Just to repeat the question, in the future, do we see a split market as retail crypto and institutional crypto?
Yeah, I agree with Phil. I think it's very clear from guys who are in the market, where retail trades, where institutions trade. But there is a very big overlap. I would say there is a very big overlap in the sense that, I think someone from a big institution was asking me recently about a deal where they wanted to do something like a Bloomberg for institutions, right? Or rather Bloomberg for everybody for crypto. But, crypto is a market where the retail guys get very easy direct access to the same pool of liquidity that the institutional guys get as well. I think for the institutional guys, the difference is, we have access to specific pools or OTC players where we can take big sizes. But there is a lot of overlap in terms of a lot of the liquidity. So it is more democratized, I think, than FX or other traditional markets. But at the same time, there is also quite a significant split in terms of the way settlements are done, and pretty much in terms of mostly settlements, I guess.
Great, thanks, Darius. So I guess we have come to the end of the panel. Let's give hands of applause to all our speakers one more time. Great. So thank you, Rana, Eric, Philip, Darius, Sisi, and also Kevin for a great panel discussion on digital assets. And of course, also thanking Philip, who has managed to join us all the way from Japan. Thank you, Philip.